Welcome back to Doc Tickers, where we break down those earnings calls so you don't have to. And today, we're going to be diving into WEX's Q4 2024 performance. Fresh off their February 6th call.
Yeah, get ready for some twists and turns.
Oh, yeah?
Because this was not your typical earnings report.
Not at all.
No.
Right. I mean, WEX, for anyone who needs a quick reminder, they simplify those business operations using software and payment processing, and they pulled in a whopping $2.6 billion in revenue for 2024. Which is a 3% bump.
Yeah, 3% bump.
Despite, those headwinds we've been seeing, right? Like fuel prices fluctuating and foreign exchange rates.
Yeah, but those headwinds are, they're really key here.
Yeah.
Because if you factor those out, you're actually looking at a much healthier 6% revenue growth.
Right.
And even more impressive, you're looking at an 11% jump in adjusted net income per share.
Okay, so that
tells a different story than the flat 3% that we saw initially.
Right.
Yeah, and it really makes their Q4 results even more puzzling, right?
Wow.
Because their revenue actually dipped 4% year over year, landing at $637 million.
And adjusted net income per share also took a hit, down 6.5% compared to Q4 of last year.
So what's the deal? What's behind the slowdown? And maybe more importantly, how's WEX responding?
Yeah. So they're definitely acknowledging those macroeconomic factors that are at play.
Yeah.
Those fluctuating fuel prices and foreign exchange rates are definitely impacting their mobility business.
Right.
And we're even seeing the trucking recession playing a part.
Absolutely.
But here's what I find really interesting.
Okay.
They're not just, pointing the finger at those external forces. They're also owning up to some internal factors that impacted their growth.
Give me an example.
For example, they were very upfront about a contract that they renegotiated with a major travel customer.
That really affected their bottom line.
Makes sense.
Yeah, and they didn't shy away from discussing the loss of a Medicare Advantage customer in their benefits segment.
Right. They were very open about that.
Yeah, and I think this transparency is actually a good sign. It shows they're willing to kind of address those challenges head on.
I agree.
Yeah.
It's refreshing to see that level of honesty from a company, right?
Absolutely.
But what really got me, I think, what really caught my attention was their emphasis on the untapped potential.
Absolutely. WEX is seeing this massive opportunity to accelerate their growth by really leveraging their existing software and payment processing strengths, particularly in that corporate payment segment.
That's really where it gets interesting, right?
Yeah.
Because they're outlining, some pretty significant growth acceleration initiatives, and it seems like they're ready to put some serious muscle behind it.
Yeah. So first up, they're doubling down on their product development.
Do we think enhanced existing offerings and, even brand new products that are designed to capture those untapped market opportunities?
Okay, and get this. They're pumping up their sales and marketing efforts in a big way, right?
Yeah.
I mean, they're adding resources to strategic high growth areas with a laser focus on customer acquisition and conversion.
Yeah, this tells me they're not just thinking about innovation, but they're also thinking about getting those innovations
into the hands of more customers.
Exactly. Into the hands of more customers.
And they're not messing around with payback periods either, right?
No, they're not.
I mean, they're aiming for 2 years or less on these investments, which tells me they're looking for a fast return.
Yeah, it sounds like a well-defined plan of attack.
Absolutely.
So now let's break down their three main segments to see how these initiatives are playing out.
Okay, I'm ready. All right, so let's start with mobility, their largest segment.
Okay.
And they've got a dominant position in the U.S. market with what they're calling a closed-loop network.
So for people who aren't familiar, what does that even mean?
Think of it this way. They cover over 90% of fuel locations.
Wow.
And a staggering 80% of charging locations.
That's a lot.
So that's a powerful network,
Right.
Especially in today's world where fuel and charging are essential for businesses on the move.
That's a serious reach, and they're looking to grow even further by expanding deeper into the market with their current solutions. But that's not all they're doing.
Right. They've got new product initiatives like 10 to 4 by WEX. And this is specifically targeting independent owner operators, a segment with huge growth potential.
I think that's smart.
And then there's a Fleet Plus, which, kind of goes beyond just fuel,
Right.
offering, a wider range of network benefits. And they're also strategically positioning themselves to really leverage, the EV transition.
Okay.
And enhance their unit economics.
That makes sense.
So it's clear that they're looking towards the future and adapting to that evolving mobility landscape.
And smart for doing it, right?
Absolutely.
I mean, we're seeing that everywhere we turn,
Yeah, and let's not forget about their acquisition of Pazer.
No.
While it performed as expected last year, they're really just scratching the surface of what it can offer.
Okay.
They spent the past year gaining, valuable customer insights. They've enhanced their sales tools. They've refined their cross-selling strategies.
Okay, so all of this points to some pretty impressive and scalable growth from Pazer.
Yeah.
In 2025.
Absolutely.
Okay.
Moving on to their benefits segment, they did experience some moderate growth, which they're attributing to an industry-wide slowdown in enrollment for HSA-eligible plans.
Right. That's impacting the entire sector, right?
Yeah, that's right. It's not just WEX.
Not just WEX.
It's across the board.
But even with that slowdown, they seem confident in their market-leading position, right?
Absolutely. They've got this diverse portfolio spanning benefits administration, consumer-driven benefits, and those, crucial HSA custodial services.
Right. They're not just a one-trick pony, right?
No, not at all. And they're not resting on their laurels either.
Oh, good.
WEX is actively, unlocking further growth by rolling out new products and features that are aimed at driving engagement with both consumers and employers.
And it's about staying ahead of the curve, right?
Absolutely.
That's what it always is.
Yeah. So, for example, they're leveraging their massive data set to provide more tailored support for HSA users. Imagine helping employees better understand, use, and contribute to their accounts.
Okay.
Which really could lead to better outcomes for everyone involved.
That's smart. So they're really using your data.
Yeah, absolutely.
For good.
By applying, those advanced technologies like AI, they're empowering consumers to make more informed benefit decisions, which, could lead to higher participation and greater funding levels.
I like it. So let's move on to their corporate payments segment, the smallest of the three.
Yeah.
But maybe the most dynamic and intriguing.
Yeah, absolutely.
They acknowledge that growth in this segment was lower than those historical trends in 2024. And they expect that to continue in 2025.
Yeah.
But they're not backing down.
Not at all.
They see a massive addressable market and they believe they have the tools to win.
Right. Yeah, and their strategy hinges on two key solutions.
Okay.
Embedded payments and direct accounts payable. So
Tell me more.
Yeah, so let's start with those embedded payments, which, initially focused on the travel industry, but has expanded to support a much broader range of industries.
Okay, so think of it as like a one-stop shop.
Yeah, that's a good way to put it.
For businesses needing these integrated and scalable payment solutions.
Exactly.
And they've been strategically investing to broaden their corporate card capabilities.
Yeah, that means giving customers more flexibility in how they fund their accounts and enabling broader issuance and settlement in local currencies.
Okay.
So these enhancements are all about attracting new business.
Okay.
And expanding their reach.
With the existing customers.
Exactly, yeah.
And it seems to be working, right? I mean, they signed several new clients last quarter.
Yes.
And they're building up their sales force to really capitalize on this momentum.
Over time, they expect these investments to significantly boost their market share and transaction volume. And while those net interchange rates might decline as they grow, their scale and cost structure should ensure that revenue growth remains highly accretive to their overall margins.
Okay.
So they're playing the long game here.
They are. So let's switch gears. Let's talk about their direct accounts payable.
Okay.
This is a software solution specifically designed for mid-market corporations looking to digitize their AP payments.
What's really unique about this offering is that it's sold directly to end customers,
Okay.
which leads to higher net interest rates compared to their embedded payments products.
They see a huge market opportunity here.
Yes, they do.
And their investments in product development are focused on maintaining and enhancing that growth. And the numbers speak for themselves, right? I mean, purchase volume for this product more than doubled from 2022 to 2024.
Yeah, that's a phenomenal growth spurt. They're on to something big here.
They are. They've got a winning combination, right? This unified infrastructure that allows them to pursue both wholesale and retail business.
Right.
Right.
Yeah. So it gives them the flexibility to go after, that high volume, low margin business, while also targeting those high margin direct sales. So it's a really smart and adaptable approach in today's market.
But what does all this mean for their corporate payments segment in 2025? Are they expecting to turn things around quickly?
Well, they're projecting a slight contraction in revenue due to, those foreign exchange rates and those one-time headwinds that we talked about.
Right.
But they're not discouraged.
They're not.
No.
Right.
They actually anticipate a return to growth in the second half of 2025 and a reacceleration of growth in 2026. They're confident that as those headwinds subside and they gain traction with their embedded payments and direct AP solutions, they'll be back on track for solid growth.
That's reassuring. So speaking of long-term vision, let's talk about their updated long-term targets.
Okay, so they've adjusted their organic revenue growth target from 8% to 12% down to a more sustainable 5% to 10%.
Okay, and their adjusted long-term earnings per share target now sits at a range of 10 to 15%. So what does that tell us about their approach?
I think these adjustments likely reflect updated market insights.
Okay.
And the renewed focus on those growth acceleration initiatives that we discussed earlier. They're acknowledging that it takes time for these investments to fully bear fruit.
But they're playing the long game.
Yeah.
Investing for sustainable growth instead of, chasing those short-term gains. And I think that's a smart strategy, especially in a market as dynamic as this one.
But it raises an important question. What does this all mean for investors?
Right.
Should they be buying into WEX's long-term vision, or are there, red flags to watch out for?
Yeah.
We'll dive into that after a quick break, so stay tuned.
Welcome back to Talk Tickers. We're picking up our deep dive into WEX's Q4 2024 earnings call right where we left off.
Ready to dig into the numbers and see what's really driving WEX's performance.
Absolutely. Last time we discussed WEX's overall performance, those ambitious growth initiatives, and we kind of got a glimpse into those three core segments, right? Mobility, benefits, and corporate payments.
Now it's time to, roll up our sleeves and really analyze their financials to understand what's happening beneath the surface. I'm particularly interested in their balance sheet. Yeah, that's a great place to start. Their balance sheet is really a picture of their financial health, which is, always reassuring for investors. Their leverage ratio currently sits at a comfortable 2.6 times.
Right at the low end of their long-term target range of 2.5 to 3.5 times, and that gives them flexibility for strategic moves like acquisitions or returning value to shareholders.
And they're not shy about rewarding their investors. In Q4 alone, they returned $106 million through dividends and buybacks.
Plus, they spent another $40 million on share repurchases just this past January. This signals that they're confident in their future prospects and believe their stock is undervalued.
It's a delicate balancing act, right?
It is.
They're rewarding investors while also, keeping an eye on those strategic M&A opportunities to fuel future growth. So now let's delve deeper into their segment performance, starting with mobility, their largest revenue generator.
Mobility brought in $345.2 million in revenue during Q4, which on a surface looks like a slight decline of 1.4% year over year.
Remember those pesky fuel prices and foreign exchange rates we talked about?
I do.
Well, they shaved off, a significant 7.6% from their growth in this segment.
So if we adjust for those external factors, their mobility segment is actually weathering the storm quite well. I mean, they're not immune to the challenges, but they're holding their own.
Yeah, they did report some softness in same-store sales, which they're keeping a close eye on, but it seems to be, improving compared to Q3, suggesting a potential rebound in the coming quarters.
That's encouraging. It sounds like they're managing those headwinds effectively. What about their payment processing rate in mobility? Any notable changes there?
Interestingly, their payment processing rate in mobility actually ticked up to 1.36%, which is about a 10 basis point increase year over year. And this is partly due to pricing initiatives that they've implemented.
So they're taking proactive steps to improve their margins, even in a challenging environment.
Yeah.
What about the impact of lower fuel prices on that rate?
Lower fuel prices do benefit their rate, though that's somewhat offset by the lower interest rate environment that we've seen recently.
It's a complex interplay of factors.
It is.
But they seem to be navigating it strategically.
Yeah.
Overall, it sounds like their mobility segment is demonstrating resilience and even finding pockets of growth.
Now let's turn our attention to their benefits segment, which reported a revenue of $186.9 million in Q4.
Okay, so that represents a solid 4.9% increase year over year.
Mm-hmm.
Though it is a noticeable slowdown compared to the first half of the year. What's driving that?
You have to remember their acquisition of a census, which closed in September of 2023, and they're no longer getting that boost in their year-over-year comparisons, so the growth appears smaller.
That makes sense, but I'm curious about their organic growth, independent of acquisitions. What are they seeing there?
Their SaaS account growth came in at 2.5%. Which is, in line with recent industry trends. However, that number is still being impacted by the loss of that Medicare Advantage customer that we mentioned earlier.
Right, the one they lost at the beginning of the year. But this is the last quarter where that loss will affect their year-over-year comparisons, right?
Exactly. So going forward, we should get a clearer picture of their true organic growth in the benefits segment.
That's something to keep an eye on. What about their custodial investment revenue? I'm curious how that's performing, especially with the recent fluctuations in interest rates.
Their custodial investment revenue, which is essentially the interest earned on the cash balances they hold for their HSA custodial clients, actually jumped by an impressive 17.9% year over year, reaching almost $210 million for the full year.
That's a significant increase, especially considering that the Federal Reserve actually lowered interest rates late last year. How are they achieving that?
Here's the key. Nearly 80% of their investments and deposits are in fixed rate instruments. That means they've locked in those higher rates from earlier in the year, providing a steady and predictable revenue stream even as rates decline.
That's a smart move, especially in this unpredictable interest rate environment. It adds a level of stability to their earnings, which is always a plus for investors.
Now let's tackle their corporate payments segment. It's their smallest segment, but it's been generating a lot of buzz, both positive and negative.
In Q4, they reported revenue of $104.3 million, a 22.7% decline year over year. That sounds pretty alarming at first glance. What's the story there?
Well, while that decline might raise eyebrows, they assured investors that it was in line with their expectations. There are a few factors at play here.
Let's break it down. What's contributing to this decline?
First, their overall purchase volume actually declined year over year, and part of that can be attributed to the renegotiated contract with that large travel customer we discussed earlier.
Right. That had a significant impact on their bottom line. Anything else?
They also mentioned that two larger customers, one in travel and one outside of travel, had temporary volume reductions in Q4. This raises questions about the broader health of their customer base.
Were these reductions expected, or did they catch WEX by surprise?
They indicated it was largely in line with expectations, and in both cases, annual volumes actually increased for these customers, even though Q4 was down.
So it sounds more like a timing issue than a fundamental problem with their business model or customer relationships.
Exactly, and they seem confident in the, stickiness of their offerings and their overall competitive positioning. They even recently signed a contract extension with one of those customers, which is a positive sign.
That's reassuring. So they're not panicking about these temporary fluctuations.
Right, they're taking a long-term view. However, there's one more factor contributing to the decline in their corporate payments revenue. Remember that true up of about $8 million for incentives that they received last year?
Yes, I remember that. How is that affecting their current numbers?
Well, that incentive didn't repeat this year, so that's also impacting their year-over-year comparison. It's important to keep these one-time events in context when analyzing their performance.
Okay, so we've covered the negative impacts. Was there any good news in their corporate payments segment? Any bright spots to balance out the decline?
Absolutely. Their direct purchase volume, which includes their AP automation solutions, grew more than 25% year over year. So that's a significant win.
That's impressive growth, especially considering the challenges they faced in other areas of corporate payments.
It indicates that their strategic focus on direct AP solutions is starting to pay off.
Yeah.
They're gaining traction in a market with significant potential.
It's a reminder that even within a struggling segment, there can be areas of strength and opportunity. Now, let's shift gears and discuss their guidance for 2025. What are they projecting for the year ahead?
They're projecting revenue to be between $2.6 billion and $2.66 billion for the full year.
And for adjusted net income per share.
They're expecting that to fall between $14.65 and $15.25.
These projections take into account their planned investments in product development and sales and marketing as well as their realistic outlook on fuel prices and foreign exchange rates. Are they being too optimistic, or is this guidance grounded in reality?
It's tough to say for sure. They're definitely being ambitious, especially given those macroeconomic uncertainties.
But they're also acknowledging those uncertainties and seem to be planning accordingly.
They're striking a balance between optimism and caution. They're confident in their ability to drive growth, but they're not making promises they can't keep.
It's going to be an interesting year for WECX. They're at a pivotal point, facing challenges, but also capitalizing on opportunities. What are your key takeaways from this earnings call so far?
It's clear that WEX is at an inflection point. They're grappling with both, internal and external headwinds, but they're not shying away from the challenge.
I agree. They're proactively addressing those headwinds and making strategic investments to position themselves for long-term success.
Their focus on product development, sales and marketing and strategic M&A shows they're playing the long game, and they're not, afraid to adapt and evolve.
They're also being transparent with investors about their challenges and providing a realistic assessment of their near-term prospects. And that's important for building trust and confidence.
And perhaps most importantly, they're confident in their underlying business and their ability to deliver sustainable growth over the long term.
We've covered a lot of ground today, but there's still more to unpack. In part 3, we'll wrap up our analysis and explore some potential risks and opportunities on the horizon for WEX. So stay tuned.
Welcome back to Talk Tickers for the final leg of our deep dive into WEX's Q4 2024 earnings call.
We've dissected their overall performance, we've delved into their segment breakdowns, and we've explored their ambitious growth strategy.
Now it's time to put on our analyst hats and assess the potential risks and opportunities that lie ahead for WEX.
Because, let's face it, no investment is completely risk-free, and understanding those risks is crucial for making informed decisions.
Absolutely. So let's start with the elephant in the room, the macroeconomic environment. It's been a wild ride lately, and it's not getting any calmer.
We know that WEX's performance is sensitive to fluctuations in fuel prices and foreign exchange rates.
Right.
And with all the global uncertainty, those factors could throw a wrench in their growth projections, especially for their mobility segment, which is heavily reliant on fuel sales. If fuel prices spike or if the dollar weakens significantly, that could put a dent in their revenue.
And we can't forget about interest rates. While WEX has benefited from higher rates on their custodial investment revenue, things could change quickly.
Right. If the Fed decides to slash rates, it could impact their profitability.
Exactly.
They've been smart about locking in fixed rates for a large portion of their investments, but they're not completely immune to rate fluctuations.
Another risk to consider is competition. The payments industry is like a shark tank with new entrants and disruptors constantly emerging.
WEX needs to stay ahead of the curve and keep innovating to maintain its competitive edge. They can't afford to rest on their laurels.
Especially in their corporate payment segment where they're up against both, established players and nimble fintech startups.
Right.
It's a battle for market share, and it's only going to get more intense.
They need to prove that their direct AP solutions and embedded payments offerings are truly differentiated and can deliver real value to customers.
So we've talked about the risks, but let's not forget about the flip side, the opportunities. WEX is not standing still, and they've got some interesting irons in the fire.
One key opportunity lies in their strategic investments in product development. Those new offerings they're rolling out, like 10-4 by WEX and Fleet Plus, could be game changers.
Those products have the potential to attract new customers and strengthen their relationships with existing ones.
Right.
It's about expanding their reach and providing more comprehensive solutions.
And let's not overlook their commitment to the EV transition. As more businesses adopt electric vehicles, WEX is well positioned to capitalize on that trend.
They're already a leader in the EV space, and they're investing heavily to expand their capabilities.
Yeah.
This is a long-term play, but it could pay off handsomely down the road.
Another exciting opportunity lies in their expansion beyond the travel industry. Their embedded payments offering is now targeting a much wider range of sectors.
That's a smart move because it opens up a huge addressable market. If they can replicate their success in travel, their corporate payments segment could become a major growth engine for the company.
And let's not forget about their strong financial foundation. Their solid balance sheet and low leverage give them the flexibility to pursue strategic acquisitions.
They've shown a willingness to acquire companies that complement their offerings, and I wouldn't be surprised to see more acquisitions in the future. It's a way to accelerate growth and enter new markets quickly.
So while there are certainly risks to consider, WEX also has a compelling set of opportunities on the horizon. It's a dynamic company operating in a dynamic industry.
Now, before we wrap up this deep dive, remember, this is not financial advice. We're just two podcast hosts sharing our analysis and insights.
If you're considering investing in WEX, do your own due diligence. Research the company thoroughly and consult with a financial advisor who understands your specific situation and goals.
Investing always involves risk. And it's important to make informed decisions that align with your, risk tolerance and investment strategy.
But now for the moment. You all been waiting for our This Is Not Financial Advice segment, where we let our imaginations run wild and cook up an outrageous but plausible trade idea.
Get ready for some speculative fun. I'm intrigued.
Okay.
What have you got?
Okay, here's the scenario. Imagine WEX takes a page from Tesla's playbook and decides to launch their own cryptocurrency.
Hold on. A WEX coin for what purpose?
Think about it. They could integrate it into their payment processing platform, allowing businesses to transact using WEX coin.
Okay.
It could be used for everything from fuel purchases to paying suppliers.
That's a bold move, but how would it benefit WEX or its customers? Why not stick with existing payment methods?
By creating their own cryptocurrency, they could potentially streamline transactions, reduce fees, and even offer rewards or loyalty programs tied to WEX coin usage.
They could potentially attract new customers who are interested in using crypto for business transactions. It could give them a competitive edge, especially in the digital economy.
Exactly. It's about creating a WEX ecosystem, a closed-loop network where their cryptocurrency is the preferred method of exchange. Now, I know it sounds crazy, but hear me out.
Okay, I'm listening. What's the trade here?
The trade is simple. Buy WEX stock before they announce their foray into the crypto world. If they pull a Tesla and launch their own coin, their stock price could skyrocket.
That's a big if, but I'll admit it's an intriguing thought experiment. It taps into the current fascination with crypto and the potential for blockchain technology to disrupt traditional industries.
Of course, this is all speculation. There's no guarantee that WEX will go down this path, and it's certainly a risky bet.
But hey, that's what our This Is Not Financial Advice segment is all about, exploring those outside the box ideas and letting our imaginations run wild.
Exactly. So there you have it, our outrageous but plausible trade idea. WEX, the crypto king of payments. Who knows? Maybe it's not as far-fetched as it sounds.
It's definitely something to ponder.
Now back to reality. We've covered a lot of ground in this deep dive into WEX's Q4 2024 earnings call.
We've analyzed their financials, scrutinized their segments, assessed their risks and opportunities, and even ventured into the realm of speculative trading.
We hope you found this episode informative and insightful.
And remember, we're not financial advisors, so always do your own research and make investment decisions that align with your personal circumstances and goals.
That's all the time we have for this episode of Talk Tickers.
We'll be back next week with another deep dive into the world of earnings calls.
Until then, stay curious. Keep those portfolios diversified and maybe keep an eye on WEX. You never know what surprises they might have in store.
Thanks for listening.